$2,000. That is the new promise. Money straight into the pockets of most American adults at a moment when the economy is already stretched to its limits. President Trump's tariff dividend could unleash more than $400 billion into the system, right as the nation barrels toward $40 trillion of total debt. So what does this really mean for your wallet, for inflation, and for the markets? Let us walk through it step by step. If you remember the last big round of stimulus that was in March of 2021, that was a $1,400 payment per person. At that time, full payments went to single filers earning up to $75,000, heads of household up to $112,500, married couples up to $150,000. In 2025, the cutoffs are very likely to look almost exactly the same. If you zoom out and apply those thresholds today, you end up with roughly 220 million adults who qualify based on those old rules. Multiply that group by $2,000 and you get about $440 billion in total checks. And remember, Trump said at least $2,000, so this program could end up even larger. Now here is where it gets interesting. The wealth gap is at or near a record high. Everyone kind of knows it, everyone kind of feels it. In the second quarter of 2025, the top 10% of earners were responsible for almost half of all consumer spending in the United States. Picture a chart that shows high-income Americans accounting for roughly 50% of all spending, up from about one-third in the early 1990s. Back then it was closer to 35%. Now it is right below 50%. This is the highest share since the late 1980s. The idea behind these new stimulus payments is that they help the bottom 90% spend more money, which is supposed to lift gross domestic product and boost growth for a little while. There is a major catch, though, and we have been talking about it on this channel for a long time. It is the inflation trap. Think back to 2021 stimulus checks hit the economy with full force, and within about a year, the inflation rate was pushing toward 10%. That spike was the highest reading since the early 1980s. Once that money is spent, the short-term sugar rush fades, but prices stay elevated. In my view, we are already set up for more inflation. We are already around 3% today. Now we are dumping even more fuel on that fire. At the same time, the Federal Reserve has already started cutting interest rates. There was a 50 basis point cut in September and then another 50 after that. Now officials at the Fed are hinting that they might pause cuts for a bit or maybe deliver a smaller move. Either way, we have rate cuts already in place, markets near record levels, and now a fresh $400 billion in new stimulus lining up behind it. To me, that looks like a recipe for more inflation and more asset bubbles. Look back at the timeline of the last few years. The pandemic begins in 2020, stimulus check 1 goes out. Then stimulus check 2. Then stimulus check 3. By the summer of 2022, inflation is pressing toward 10% again, the highest rate since the 1980s. It did fall sharply over the next year into the summer of 2023 and continued to cool into 2025. But recently, it has started to creep higher again. Now the tariff dividend has been announced, and the next chapter of this experiment is about to be written. Here is the problem. The math does not work. Trump says tariff revenue will fund these checks and that any money left over after the payments will go directly toward paying down the national debt. Take a look at the debt numbers. The United States has added about $10 trillion in just 5 years. Our brains are not built to really understand how massive $1 trillion is, let alone $10 trillion. It sounds great on paper to say tariffs will fund checks and debt reduction. In reality, the numbers tell a different story. In August, the federal government collected around $30 billion in tariff revenue. The federal deficit just in August was about $345 billion. So tariff revenue covers around 10% of what we are overspending in a single month. Since the start of the fiscal year on October 1st, we have already added hundreds of billions of dollars to the debt, and the total is racing toward $40 trillion. That is not a path that can continue forever. Supporters of modern monetary theory argue that it is sustainable and that deficits do not matter the way most people think, Yet the more currency units you introduce into the system, the more pressure you put on the purchasing power of the dollar. So what are the implications for markets, and what are the big takeaways? Despite everything we have just gone through, the S&P 500 is only about 3% below its all-time high, and it is up roughly 35% since April. Tech stocks were hit hard for a few days but have already started to bounce. We will see some volatility. Markets cannot rise in a straight line forever. What is clear is that this market loves liquidity, which is another way to say it loves more money entering the system. The tariff dividend is pure extra liquidity. At the same time, the largest technology companies are spending around $200 billion each quarter on artificial intelligence-related capital expenditures. Michael Burry even decided to shut down his fund because he does not trust the way all of this spending and depreciation is being accounted for. The artificial intelligence boom is surely creating real opportunities, but the big question remains: is this turning into a bubble? Some recent surveys from large banks show that many portfolio managers believe the answer is yes, at least over the near term. In the short run, asset prices are pressing back toward record highs. In the long run, this policy looks more like an involuntary tax. You might receive a $2,000 check today, but you could end up paying it back and more through higher prices in the future. That is inflation in action. Over time, inflation quietly punishes savers. If you keep a pile of cash stuffed under a mattress or hidden in a wall, what do you honestly expect it to buy 50 years from now? Do you really think physical cash in its current form will still exist at that point? That is a dangerous assumption. So what can you do? In my view, the answer is to own assets. That has been a core message on this channel for years because inflation erodes the value of idle cash. Stocks, real estate, Bitcoin, productive land, and profitable businesses give you a chance to stay ahead of rising prices and preserve your purchasing power. So, what do you think? Is this tariff dividend a smart policy that helps everyday people, or is it just another short burst of stimulus before the next inflation wave? Let me know what you think in the comments. As always, thank you for watching and staying with me until the end of the video. These episodes take a lot of time and research to put together, and I appreciate you spending your time here with me.